Hello, I'm Brett Carleton, coming to you from the offices of Heritage Wealth Management. And from all the team here at Heritage, I'd like to wish you a Happy New Year. Before I get into just a quick recap of 2024, I wanted to say I'm going to try to do more of these this year, more than just one a quarter. So I'm going to try to keep these a little bit shorter. So the ones that sound of interest to you, you can watch, and the other ones you can skip if you'd like to do that. So anyways, as we look back over 2024, obviously, it was a presidential election year. That was a big story. We'll talk a bit about that. But really, from an economic perspective, it was the Federal Reserve in September beginning to lower interest rates after about 2 years of raising interest rates and then maintaining them at a high level. And that did a lot to really drive the stock market forward, and I think continue to help the U.S. economy grow as we finish the year strong. So we had the S&P 500 up over 20% this year, as we did in 2023. We haven't had back-to-back years where the S&P 500 was up over 20% going back to the late 90s. So it's been 2 really good years following 2022, where both stocks and bonds were down. So is there any reason to really think that that's going to change? I don't think there is. As we look into 2025, we got to talk about the 3 T's, I guess. We've got the new Trump administration. We've got the tax reform. Will we extend the tax cuts from 2016? And then we've got the talk of tariffs. So I plan on going into more detail into each one of these topics as we see what's going to happen or what's coming out from these administrations. I don't want to speculate a whole lot at this point, but we'll talk a little bit more about that as we go forward. So both in 23 and 24, we saw lower volatility than normal, which is, especially in 24, is unusual because it was an election year. I think the largest drawdown we had in the equity markets last year was about 8%. And if you remember, in a normal year, the market drops about 14% somewhere during the course of the year. And in a presidential election year, it tends to be even higher than that. So we've had this rebound out of 22 that the market has been steady and growing ever since, and we just didn't experience that volatility. So I'm not making any predictions, but as we go forward, I would expect to see more typical volatility in the equity markets. A couple of reasons. The market appears to be fairly fully priced, so we're going to need earnings growth to keep the markets going forward. So we won't be surprised to see additional volatility. I'm not expecting anything real negative, but just more of the normal volatility that we would expect in a typical year in the equity markets. It appears that the concerns around inflation are waning. Monetary supply, which is a big driver of inflation, has gotten back to more normal levels. So hopefully we will see inflation remain tame. The one area is still housing, which is basically the only part of inflation that has not come back to within the Fed's parameters. So we will have to watch what happens with housing. But right now, from a consumer perspective, employment is strong. Consumer debt ratios are below historical averages. There's record amounts of cash between bank savings and checking accounts and money in money market accounts. There's almost $24 trillion sitting in reserve. That typically is stimulative because that money can be put to work, whether it's buying equities or other investments or just used by companies to reinvest in growing their business. Spending, consumers continue to spend. As we know, Americans love to shop, and they're continuing to increase spending. Corporate earnings have been strong and continue to grow. So these are all reasons for optimism as we look out into 2025. Back to the 3 T's, I'll touch a little bit on the tax bill. In 2016, there was a tax cut that had a 10-year time period. It's expiring the end of this year. I think it's really important that we get something permanent in place. The reason is that businesses aren't going to make major capital investments until they know what the income tax environment is going to look like. It also helps individuals because we all have to make decisions based upon what the income tax rates are. But the one thing that they don't talk a lot about is most of the American businesses are run by maybe an individual, maybe it's a partnership, but those millions of businesses are all taxed at people's highest marginal income tax rate. So it's not that corporate tax rate that people talk about. So I'm very hopeful that they will get something in place, and we will not have an income tax increase at the end of the year, because that impacts everyone. So I will talk more about tariffs. Tariffs typically aren't inflationary. They aren't necessarily a huge concern to consumers, because consumers can pick other items that weren't affected by tariffs. But the problem is it disrupts global trade. So I'm not a big fan of tariffs, and I'm hoping that what's coming out of the Trump administration is more just talks for negotiation. So we will wait and see, and we'll talk more about that as we move into this year. So as always, we plan for the unexpected as part of your portfolio. That's why we have the safer piece of your portfolio, and that is the fixed income piece, just in case equity markets do experience higher volatility this year. So I'm going to end on that, and I am going to follow up this first quarter with some more specific topics that I'll delve into a little bit deeper. But again, if you have any questions or comments, please let us know, and Happy New Year to you.